When we're in the fourth quarter, the market is trying to figure out 2019 earnings level.
We're over 600 points on the Dow. The S&P down over 3%. The Nasdaq down over 4%.
The volatility remains high. Investors are shooting first and asking later.
A very rapid move higher in 10-year yields, 20 basis points in just a few days.
The Nikkei 225 is the loss leader, knocking on the door off an 800-point loss as we speak.
Good morning. Welcome to Bazaar Morning Call. I'm Lata. With me are Anuj and Sonia, and it looks like a rough morning of trade. You already saw the montage of comprising the falls on Wall Street and in Asian markets. It's typical risk aversion. There's a flight to safety, flight to the usual safe havens. Dollar is stronger. The dollar index is almost 96.5. US Treasuries are actually attracting a lot of money, and the yields are far away from the 3.25, now closer to 3.15 because it's attracting so much money. The yen is up, and typically all risk assets, which is largely equities, have fallen sharply. Yesterday we had a rally in financials in particular and in the mid-caps in general. That rally may be payback time today because we saw the risk aversion signs in Indian markets as well, 2,047 crore of selling by foreign investors. So, well, we have to brace ourselves for a difficult morning for sure. Morning, both of you anyways.
Hi, Lata. Good morning. Hi, Anuj. Morning. It's so disappointing, you know. I thought we would start the day by talking about Virat Kohli becoming the fastest batsman to reach that 10,000 runs in an ODI. But cold water was poured on their enthusiasm with the way the Dow has moved. In any case, I mean, I take your point about...
The record remains.
Yeah.
Let's rejoice.
And the celebrations remain as well. But I guess the overarching theme today would be the sell-off in the global markets. Also, it's F&O expiry today. So, you know, that's going to take precedence in the second half of the day. The Nifty is now down, what, almost 6.5% in October. The mid-caps are down 4.5%. So let's see which way things go. Earnings have not been that great either. We've seen some big disappointments from Interglobe, Hexaware, Lakshmi Vilas Bank, etc. Anuj, morning. I know you'd want to talk about cricket as well, but you think for our markets, after the initial gap down opening, there would be any recovery?
Yeah, morning, Sonia. So, you know, just to carry forward that point, it was a tie after all, right?
That was the biggest disappointment.
Bit of an anti-climax. Yeah. You know, in the end, you know, you saw Shea Hope and you saw Virat Kohli, and both are thinking whether to celebrate or whether to, you know, be unhappy. Nobody knew.
Well, I think the Windies could at least celebrate after the kind of a rough time they've had.
So that's why, you know, yesterday I was looking at the data yesterday, and I was doing closing bell yesterday. Trust me, the kind of moves that we've seen in just 1 hour of trade. Yesterday at 120, the Nifty future was at 10,227. By 220, it had moved to 10,116, 111-point move. And at 320, it had again moved to 10,245. Intraday, 100-point decline first, more than 100-point decline, and then more than a 100-point rally. Look at the Bank Nifty at 120, we were at 25,183. The market had a sharp slide of about 400 points intraday, 24,841. Equally sharp rally back towards 25,140. So the simple point is, this is a no-trade zone market.
Very volatile.
Very volatile market. This is the time in which, you know, you plan your holidays. The airfares are down. The, you know, the global economy is in a bit of a recession. You will get good deals. Go to hotels, get good deals, and enjoy, and come back and trade. If you're a compulsive trader, trade this range of 10,100, 10,300, buy sharp declines, sell sharp rallies. Yesterday, if you bought sharp declines and sold sharp rallies, you would have made money. Easier said than done. Of course, I'm sure those who trade would tell me that. Expiry today, so keep an eye on HDFC Twins as well. But no point losing money in a market like this both ways. Just be nimble-footed. And, you know, again, a point, keep an eye on companies which are falling despite good numbers because the market is down. And companies which are in good stead, because when the next you know, bull market will happen, some of these companies will do well. So perhaps the time to build some sort of portfolio. That's the only way I think you can approach this market right now.
That is the way to approach. I mean, if we, after all, everyone has a salary coming in every month, and everyone has a retirement and other responsibilities to save for. Rather than hating when markets fall, that is the time to, you know, pick up your prosperity days, pick up these stocks. and one day it will be payback time. The roughness is more going to be, look at the nature of the stocks that ran up yesterday. BSE Realty was the best performer. I mean, that's always a risky sector. And of course, BSE Financials, again, largely NBFCs. The expectation is some munificence will come from the government and the Reserve Bank. It may be a little bit of payback time because whatever comes will be a trickle. It's not going to, solve problems overnight because these are deep problems. And therefore, rushing into these stocks expecting that there's going to be a bonanza from the government may not be a very wise thing to do.
Okay, well, it's going to be a rather long day. Initially, the SGX Nifty is suggesting a gap down opening, but we have so many numbers coming today as well. Maruti, Bharti, BHEL, PVR, Biocon. The list is pretty endless. But let's take a look at what our wise experts have to say as we head into trade this morning. Derek Higa of William O'Neill says Asia Pac continues to be very weak with all 13 markets under their 200-day moving average. He says the MSCI Asia Index has made a new 52-week low and the next support could be 3 to 5% lower. He says the Asia Pac focus list is now at historical lows as technical deterioration has resulted in constant removal since September. He remains extremely cautious and continues to recommend a defensive approach if raising cash is not possible.
Okay, there, raising cash would be one option that many people would want to get to now when it will be most difficult to sell. Okay, money market views. This one comes from Mohan Shenoy of Kotak Mahindra Bank. Mr. Shenoy says weakness in US stock markets is spilling over to Asian equities. He says the dollar has remained stable against most currencies while losing ground to the yen. Mohan Shenoy expects the rupee to have a mixed session with weakness in equity markets offset by falling Brent crude oil prices. He expects the USD INR to trade in a range of 73.10 to 73.50 for the day.
He also says lower oil prices and a stable rupee are positive for the bond market. He says OMO purchases today by the RBI is also bond positive. He expects the 10-year benchmark bond yield to trade in a range of 7.83 to 7.88% for the day.
Okay, well, the global cues, they look quite bad, quite ugly actually. Dow was down, what, 600 points? Here's Nigel with the world view.
Well, that's right. In fact, overnight, the US markets, they took a sharp knock, down between 2.5% to around 4%, depending on which index you're looking at. And the Dow has erased all its gains for 2018 itself. Remember, for this month itself, it's down anything between 7 to around 12% odd. Overnight, we had the volatility index that, in fact, did spike up by close to around 20%. And in the month of October, that index has nearly doubled from around that reading of 13 all the way to around 25 odd. And yesterday, nothing was spared. From all sectors, we did see selling. Caterpillar came in for the second day running to see some selling. We had a couple of those banking names that did see selling. And in fact, even Microsoft was down close to around 4% in yesterday's trading session. Even Goldman Sachs was down nearly around 3.5% odd. So yesterday wasn't a great trading session at all. But the FANG stocks, they have come in for particular punishment in the month of October. Facebook, Apple, Netflix, as well as Alphabet, all of them down between anything between 6 to around 10%. And that's, something that we have been focusing on here on Bazaar Morning Call itself. The data points are not looking that good. There's worry that, in fact, the US economy is not growing as much as expected. The new home sales fell to a 2-year low. So not a great data point coming out of there. But shifting focus then, if we move, to the key reasons why we're seeing the selling, slowing global economy. Now we're talking about valuations even in some of those developed markets. And Italian government as well as the European Union, they have been in a bit of a tussle, so that's not good news. And the global trade tensions continue to play out. In overnight trading session, the FTSE was the only one that ended mildly in the green. But otherwise, things didn't look good at all. Deutsche Bank came out with a set of numbers, missed estimates. Stock was down close to around 5%. No great global cues, and that's precisely what the Asian markets are telling us this morning. Brent crude prices, the only positive, holding at around $75.50 per barrel. But the dollar index is showing some strength. So keep an eye out on the rupee. It's been a relative outperformer for the last couple of trading sessions. 100 points downtick to kickstart trade. Back to you all.
Okay, Nigel, thanks a lot for that. Samir Arora is with us, the founder and fund manager of Helios Capital. And of course, Adrian Mowat, emerging market equity strategist, also with us. Good morning, Samir. In good mood today? Or you think the markets set for more decline and perhaps will need some kind of holiday?
Without the curtain up, maybe not.
Okay, Samir,
I think Samir is not able to hear us just yet. Okay, well, Samir, if you can hear us.
Yes, I can.
Okay, well, yeah. How does it feel? Does it feel like we're in for the long haul of rough days? Or is it that it won't be as bad? The fall may turn, probably because there are other fundamentals which are looking good. How does it feel? You want to move into cash?
No, I don't want to move into cash. Actually, I think that the US will recover and India then, whatever it does. But first is that, US, the earnings growth is quite strong, and even if people want to move into dollar assets, it'll help both US equity and fixed income. But actually, US equity is very attractive. I don't think that the earnings will disappoint much, although yesterday some housing starts were bad. Coming to India, normally, like we learnt in 8, that if oil crashes, it doesn't help. But if oil corrects and the rest of the markets stabilize, then India, it obviously is a gift to India. So for the last 4-5 days, I was thinking that India will do better, but it hasn't, although yesterday it was okay. So right now, I am not excited or feeling depressed. We have to see it for a few more days. But India could solve some of its own problem, which it doesn't seem to be grappling properly. So that's another problem, that not 100% of India's problems are because of the world or oil. It is to do with the fact that our regulators are too laid back.
Good morning. Just to carry forward that point, the market have shown some resilience, especially the financials. This month, in fact, the Bank Nifty, for example, is not really collapsing. The price damage perhaps in big stocks is not as much, except for, say, stocks like Reliance. So would you take heart from that? Do you reckon the worst of the price damage could be behind us?
See, this month, whatever we say is better than last month, because last month India was standing out and it looked as if it is, completely India's problem, which makes it more glaring, more questions, more pressure on fund managers. This month, although India's down nearly as much as last month, or maybe a little less, but at least it's in line with the world, or maybe even slightly better. For us personally, we have liked this month better because, as we have said to you in the past, we missed the tech rally by not having enough tech, and so we are very happy this month relative to previous months. But in general, I would think that India has 3 problems, let's say. First is global problem, if it is that we are part of the world, which I think we were anyway not participating on the upside. So the second was oil, which now looks a little bit decent. 75 after having seen 80 odd looks like a big relief. And the third is our own creation of the way we are sitting on our hands in terms of resolving the NBFC's issues and thinking suddenly that we cannot bail out because it's a private company or that's a sector which did excesses. It's like saying that if you're on the 3rd floor of a 10-floor building and you have once or twice lit fire because you were smoking in your bed or something, and 4th time or 2nd time, the ambulance or the fire brigade doesn't come saying, sorry, you should have known that this can cause a fire, not realizing that there are 7 or 10 floors above your apartment and all those people are stuck because of you. So you can penalize these guys separately. But today, effectively, by the government or the RBI or whoever just sitting on their hands, I think it is pretty serious. So third part, in theory, you could solve on your own, or not solve completely, but contain it, and then you would still be at least outperforming from here on because of having suffered on this account before.
Okay, Sameer, hi, good morning. Love your analogies as always. But we were talking to Arvind Sanger last morning, and he did mention that the bigger problem that global equities are facing is what's happening in China. The economy is apparently growing at the slowest pace since the financial crisis. You are closer to China than we are. So tell us, is the situation as bad on the ground, or are people... Go ahead.
I have no idea, although personally I have 3-4 stocks in China. One of them, as you know, has lost $250 billion in market cap, which is the biggest loss ever, I think, which is 10 cents. But anyway, so in China, my big picture would be that, as always, that China's problems help a little bit India if it only leads to reduction in oil prices and in general tilt towards India. Because the point is there are 2 issues. One is the pie, the size of the pie, which let's say emerging market pie, and second is allocation within that pie. So let us go for the second part, if not the first part. The first part could be that the allocation to emerging markets goes down, let's say, because China is a big part, maybe 27, 28% of the index or something like that. But the second part is that we are relatively not proving ourselves as a better market to invest in because people are frustrated with the things that have happened in India this year, starting with LTCG, which, by the way, I'm still fighting for because I challenge the government or anybody, the income tax, to even tell me how to calculate my NAV. Everybody is approximately calculating NAVs, which, because nobody cares other than me, we move on in the world, but it is, I can prove that everybody's wrong. So anyway, starting from that, and then, this HPCL disaster that we did, and then we did this disaster of the government telling that these three banks have been told to merge, and then Reserve Bank of India coming in the middle of a crisis, and instead of saying that, give these guys 6 months extra, who cares, telling the bank that sell now, and the stock fell 20%, because what happens is not that stock, which I didn't even have, by the way, is that then three other stocks fall, and then the fifth falls for some other reason, and after some time the market has fallen, not to do with oil and not to do with the US stock prices and not to do with China slowdown, but us randomly in the middle of a crisis doing things which are costless and then trying to do costly things by, giving subsidies and all, where some of these things there's no cost to the government other than to come and say. And then for somebody to say we don't care for the currency, but separately we do care, but this committee doesn't care. I mean, these kind of things, even a hedge fund manager would not say about his own market. I would not say, even if I'm short a stock, that I want it to go bankrupt. There are limits to which you should say, and then look at it differently. It is RBI which defined ILFS as a systematically important company. You think any NBFC said it? You think any hedge fund manager said it? It was an RBI definition. So if RBI cannot audit that company properly after itself calling it systematically important, what right they have to give lectures to the world on ALM and stuff like that, and then let it be there only 40% of 20% of this step by saying this, but not following up. And so now nobody gives money to anybody because nobody knows what the rule will be. Say there is a rule or say there is no rule, but don't put your mistakes effectively on the system at large for no real reason. So that's why I still feel hopeful, because some of these things are on our own account, and you always feel that what is on our own account can be reversed, but who knows?
Yep. We have to wait to see what the regulators and the government do. But Samir, do stay on. Adrian Moat of the Emerging Market Equity Strategist is also with us. Good morning, Adrian. How does it look? Do you think the recovery will first come in the US? Is this likely to be a long sell-off? Or is this a capitulation and then, you recover because the US is still growing and growing well?
Yeah, so I think we need to compare the sell-off with the sell-off that happened in late January, early February. So the catalyst for the sell-off was a sharp move in 10-year bond yields. So that occurred in January, occurred again in September, and then you begin to get a correction in the market. The results season, I think one could argue, was probably just as mixed, going back to the January, February sell-off as it is today. We have had some really good results out as well as some poorer results. As I think about it, I think it is going to prove to be a bit like the sell-off we saw in February. It'll take the market some time just to sort of gather its nerves. But I think on a 12-month view, that'll make sense buying into this. What I do think is very different today versus the beginning of 2018 was in 2018, two very powerful forces were at work. One was that US interest rate differentials were moving rapidly in favor of the dollar. The other thing was that earnings growth, courtesy of the tax cuts, meant that the EPS growth in the United States exceeded the EPS growth in emerging markets by some 14% this year. Thinking about 2019, and that's what markets should be doing in the final quarter of 18, the earnings per share premium, I think, will move back in favor of emerging markets. I would also argue that quite a number of the emerging market currencies have overshot on the downside relative to the dollar. So I think that what is different about this sell-off is this sell-off will actually prove to be a catalyst for a rotation of some capital out of the United States into other equity markets. Now, Samir was talking earlier about China. What I would highlight about China is there is a meaningful change in policy. I'll focus on short-term interest rates, so 3-month Chibor. We started the year with Chibor just below 5%. It's currently 2.8%. There are clear signs of easing in China, as well as some supportive policies for consumption, increasing the tax thresholds for individuals, I think is going to be important for the consumption story. There's a reduction in import tariffs for some consumable goods. So we've got a story here where there's a lot of pessimism over China and EM in general. And I think the relative story throughout 2019 is going to be that EM begins to look better than the US in terms of the rate of change. And that's when you look at positioning, which is very heavy in the US and underweight in the EM, I think is going to prove to be quite attractive. So the advice is hold your nerve, do your analysis at the stock level, make sure the earnings are coming through, and get more money to work into this sell-off.
Okay, Adrian, good morning. So that January parallel is okay. What some people are scared about is some parallels being drawn with 2008 and 9. You think that's far-fetched right now?
No, because let's remember what 2008 and 9 were about. This was about property markets throughout the Western world being overvalued with very poor risk management of the leverage in those property markets. I see no evidence of general overvaluation across countries. There may be specific examples in certain cities. And there is significantly better control of leverage. You know, you can't get 110% mortgage in the United Kingdom off Northern Rock. You don't have the subprime dynamics. We don't have these complicated offshore structures. So I think it is inappropriate to look at the 2008-2009 analogy. It is certainly true that the US economy will slow down next year. That is predominantly a function of the fact that you don't get a fiscal impetus from the tax cuts that the Trump administration put in this year. But when I look at the key dynamics for the US, which is consumption, we have job creation and we have wage inflation. The US consumer is alive and well, keep that economy. If we can get some reduction in the tension between China and the United States, then I think that's going to be very helpful for corporate capex by reducing uncertainty. And then we'll probably be feeling much more confident about the global economy into 2019.
Okay, thank you for that sane advice, Adrian Moat. Thanks for joining us. Samir, same question to you. Do you think it's an irrational fear to compare this situation to 2008?
It's absolutely irrational. Big picture being that, 2008, if you look at the market, the fact that the market fell 60% actually happened after 1929. Normally, even if you look at the Indian market falls, they've always, sort of ended at 25, 30%, because at least in 94 when I've been around, 60% fall, it was a once in a 70, 80 year type of event. And there's no reason why that kind of thing is happening now or should happen suddenly. Separately, as I was saying, why I'm not overly bearish, or my net is in the 55, 60% range now, which is my normal range, is because if I look at it from, our fund started in 2005, so from that day I have the data in my head. There have been basically 3 years in which the currency has depreciated, that is 8, 11 and 13. And if you look at it outside these 3 years, from 2005 to today, the currency has been absolutely, and this year, if you look at it outside these 4 years out of 13 years, that is for 9 years, the currency has been absolutely flat, which means that broadly it happens in a year, and it's happened in the same range of 13, 15%. In 2008, it depreciated 19%, but otherwise 12, 13, 14%. And then you look at the following years, all the years have been very massive Also, I read yesterday Mark Mobius interview, maybe gave it to your channel, which I agree with, that the bear markets are generally much shorter in time than bull markets. So I think that sometime next year, the problem isn't going from here to that sometime, but sometime in 19, maybe pre-election, maybe post-election or whatever, you will have a big outperforming rally, at least, equities doing better than everything else, and maybe hopefully India doing better than others. The question is from here to there, what happens and how much do you fall? But it is not 2008 in anybody's mind, I think. That was a very different.
No, that's most useful to break those analogies so that people don't panic unnecessarily. But in the meanwhile, Samir, for those who get a monthly check and have to park it somewhere, what's the advice? Is it that you carry on with your SIPs for mutual funds or stay in cash? What's the advice?
I think you close your nose and put it in. Even yesterday, I bought 2 stocks which we own, which are consumer stocks, and both were down around 30% year to date. We don't know even why they are down. We don't exactly know what is wrong, but we don't think anything is wrong. We just randomly bought 0.5% more of our fund just because the formula is that in a very volatile market, let's say you compare point-to-point returns, which means if you have money invested today and then you say, I won't ever look at it again, and then X number of years later, say 5-7 years later, you find that equity was the best thing to do and this money has done better than whatever. That is old history. But if the market is volatile and during that point-to-point returns that you're comparing, in between, on down days, down years, down periods you added, by definition you will have much better returns than even this point-to-point returns, because you have added on a down, somewhere down compared to whatever points you're comparing. And point-to-point returns of India are very good. We all know that if you look at the last 7 years, 10 years, at least in rupees been very good. And just because 7 peaked in dollars still doesn't look very good, but in rupee terms the returns have been very good. So big picture, you can delay it by a month, nobody cares. But broadly, you should buy the market. Don't have to buy the same stock, but you should buy the market, because the market generally have 100 years history across multiple markets that they do well over time. And the more volatile the market, better your averaging helps, because that means it falls also as much.
I wanted your thoughts on a couple of these minor accidents that we have had. For example, IndusInd Bank and the way that stock has fallen. Is there some kind of irrationality here, or is this something where the market's fears are genuine?
No, I don't consider irrational. We own it, by the way, but I don't think it is good or bad. The stock has been down, I think, 5-7% year to date. So it's okay. Many of these stocks, private sector banks, are up maybe 5-7% year to date. Obviously, the fact that they had ILFS was per se a negative, and so for that it falls 5%. It doesn't matter. If you see that day it fell 8%, but after that I think it's recovered 2, 3, 4 of that already. So I don't consider a big accident unless more names come in. But I would now ask Lata one question. That Lata, since you interview all these regulators, please tell me, how is ILFS an NBFC? What is the definition of an NBFC? It's an infrastructure company borrowing money and investing in its projects. An NBFC, I thought, means somebody which borrows money and then lends to other borrowers and does, diversification of customers and diversification of projects or whatever. So we have put everything in one. It's an infra company that has failed, and it should be treated like that. But I don't think that IndusInd has broadly, massively underperformed anything for me to feel bad. It just lost a little bit that day, and that was maybe deserved.
No, I'm not holding brief for anybody. It's NBFC is only a working definition, and I guess it will be treated ultimately. Actually, which of our infrastructure financing experiments have succeeded, Samir? Every one of them, ICICI, the Development Financial Institution, IDBI, IFCI, IDFC, even through the private sector when we try to finance infrastructure, every one of them has failed. Whether the nomenclature ultimately becomes unimportant. Either we are not making rules for infrastructure properly, we are not paying paying for it properly or we are not financing it properly. That's a conundrum which India has to resolve, but that's that discussion for another day. The more important question, Sonia, you're going to ask him.
Yeah, in fact, we can go on this endless debate about NBFCs and the solutions, etc. But are you looking for any opportunity in this adversity? I mean, Bajaj Finance, for example, Sameer, yesterday was up 11%. You think that's a good buy?
Very little on that before the results the day before, but not any of the others because we already have them. In fact, because we also, as I told you last time, we have around 10-12% in NBFCs. So we shorted around 5-6% in some other NBFCs to try and go through this period. As I said, in the end, I think nearly all of them will survive or all of them will survive. But this pain, obviously, we also want to reduce as much as possible without giving up on what we owned. But I am saying, and I still feel that, and I tweeted on this, that we have outperformed the world if you exclude all the self goals.
Okay, but they always come with self goals, don't they? Thank you very much, Sameer Arora, for joining in, and Adrian Moat as well. The most important takeaway is that we should not overemphasize the analogies with 2008. And in fact, we should not even be mentioning them, because that was a different period when we had very poor regulations for shadow banks, that's NBFCs. We had fancy derivatives, extremely little capital, even in banks. So forget non-banks, they were almost operating on zero capital, and of course, highly overpriced real estate. So these analogies should not be taken too far. Maybe February is a good example, because we did see a 10% fall in S&P 500 and in the Dow, and then it recovered. So it's entered correction territory. Let's wait and watch and see how things are at the moment. Yes, brace up for a rough day today. We'll take a quick break and we'll alert to you the stocks that you should watch out for.
Hi, welcome back to Bazaar Morning Call. Looks like it's going to be a really tough morning of trade. Most indices are at the low point and the SGX Nifty is still indicating a 100-point cut. Our research team is here, though, to give you the list of top 10 stocks as we head into trade this morning. Anuj, given the market mood, what are the stocks you would be looking at?
I think today is a day where you play safe. You play the boundaries in the market today. Sonia, today is expiry day, so I'll be watching out for the 3 p.m. factor today. My sense is today you'll have a big 3 p.m. move. So the stocks that I'll be watching out for would be the usual suspects: HDFC Twins, HDFC for Nifty, and HDFC Bank for Bank Nifty. Today, of course, is the monthly expiry, so both Nifty and Bank Nifty perhaps could have that 3 p.m. move. So these are the couple of stocks to watch out for. You want to watch out for Reliance. You want to watch out for ITC. And see, I think today is the kind of day where you perhaps don't chase. You see the markets, if they're breaking down, you try to sort of buy with the risk reward in place, and if there's any big intraday recovery, perhaps you try to sell into that kind of day, and not a day where you want to take aggressive positions.
Okay. Well, Sonia, let's start the results parade first. Interglobe.
Okay, disappointing. It's the first loss that Interglobe has posted since going public. So, this is something that the street will definitely not like. A huge net loss of 652 crores. Higher fuel costs, rupee depreciation, competition has impacted their profitability. The EBITDA has come in at a record low, down 86% year-on-year at 220 crores. The EBITDA margins have fallen to a record low as well. Just to give you a sense, you'll get a couple of graphs on your screen. The yields have also fallen to a multi-year low. Now, the EBITDA trend for the last 4-5 years, they've been doing an average of around 1,100 to 2,000 crores of EBITDA. This time they fell to 220 crores. So that's the kind of erosion that we've seen for them. And, I shudder to think what the fate of the other airline companies would be if the market leader is performing like this.
Typical of airline companies to list when crude is at 30 and then post losses when crude is at 70. Well, the other big Nifty stock that announced numbers, Wipro. Rima?
Well, it's a good quarter. Q2 has been better than what the street was anticipating. The Q3 guidance is in line with expectations. A run through of the numbers: revenue growth at 2.8%, margins have improved to 18.1%. Their Q3 guidance is 1 to 3%. Of course, all this has been aided by the acquisition of Alight that they did. Now for Wipro, the big question is sustainability of a good performance. Valuations are inexpensive when you compare it to peers. It's trading at 14-15 times forward multiple. The stock is down 2% in 2018 versus the Nifty IT, which is up 20%. So there has been an underperformance. Valuations are cheaper than peers, and Q2 has been a good quarter.
Okay, thank you very much. One can welcome all kinds of good news. The NBFC numbers, L&T Finance and MM Financial, Abhishek?
Well, Lata, to begin with, L&T Finance, the numbers have been too good, but just to alert our viewers, they have an exposure of 1,800 crore to IL&FS, and they have exposure of 800 crore to 3 projects of, super tech. Now, coming on to the numbers, the disbursement growth remained muted in single digits. However, the AUM growth remains strong at 24%. That drove the net interest margin, which has been on an improving trend since the last 4 to 6 quarters. The gross NPA also improved by 80 basis points as it came down to 7.1% versus 7.9%. For M&M Finance, the disbursement growth was really strong at 44%. That drove the AUM growth to 10-quarter high. The spreads have been improving. Net profit at 381 crore versus pool of 299 crore, while asset quality also improved over there. Back to you.
Okay, thanks a lot for that. Midcap IT, there were a lot of numbers post-markets yesterday. Rima, how did it look?
Well, let me start with L&T Infotech, where the steady and strong performance continues. The key highlight is the fact that the company continues to post very strong growth. So on a constant currency basis, growth has been at 22.9% on a year-on-year basis this quarter. And the bar chart will tell you that this has only been on an improving trend. The management says FY19 growth to be better than FY18. That said, the stock has already rallied 50% so far in the year. For KPIT Technology, the key positive has been the margin improvement in this quarter, which leads the company to up its margin guidance for the full year. So they're saying they'll exceed their margin guidance of 11.5% to 12.5%. So KPIT is good numbers. Hexaware is a revenue miss, and on account of that, the company has lowered its full year revenue guidance by 100 basis points. So disappointing numbers for Hexaware.
Okay, thanks a lot for that. So Hexaware's disappointment is in line with all the other negatives that we've got in the mid-cap IT space. But Sonal is also here with us. She'll talk about some other numbers that came through post-market hours. Sonal, over to you.
Thanks a lot for that, Sonia. Well, I'll start with Lakshmi Vilas Bank. Weak set of numbers reported by the bank. Not only the NII, that fell around 35% on a YOY basis. The gross NPA ratio, that came in at multi-quarter high at 12.3%. That compares with 10.7% on a quarter-on-quarter basis. They also reported a loss of 132 crores this time around. Moving on to IDFC Bank, the bank reported a loss of around 370 crores this time. However, the asset quality, that has improved. Gross NPA ratio has come in at 1.63% versus 3.24%, and net NPA ratio has come in at 0.59% versus 1.63% on a quarter-on-quarter basis. Moving on to Syngene, a mixed set of numbers coming in. Revenue growth was strong at 25%. However, margins were a miss. They were down 370 basis points due to higher other expenditure. Last, Bharti Infratel, the numbers were largely in line. However, the margins were a miss. They came in lower by 40 basis points. And in last 6 quarters, the margins have declined to around those 41% levels versus 45%. So some red tick is expected on the stock.
Okay, thank you very much for that, Sonal. And another news development, Tata Steel asking Tata Sponge to buy Usha Martin and not buying it itself. Nigel, tell us the impact.
Well, Lata, I expect Tata Sponge to be under some pressure, while Tata Steel could see a bit of a relief because, it's not coming in their own books. They're doing it through one of their subsidiaries. As it is, as of now, Tata Steel owns 54% stake in Tata Sponge. The problem for Tata Sponge is currently, yes, they're holding around 700 crores of cash, but this asset will cost them nearly around 4,500 crores. So clearly, they have indicated that they're looking at a rights issue, they're looking at some borrowing, and also they'll be looking at a bit of a preference issue, non-redeemable preference issue to Tata Steel. The short point is Tata Sponge moves from a net cash to a net debt company, so that stock could be under some pressure. Going ahead, maybe Tata Steel could think of merging it, etc. But for the time being, the stock could be under some pressure. For Tata Steel, they already have more than 1 lakh crore in terms of debt, so at least it's not coming in their own books. They are routing it by one of their subsidiaries. So keep an eye on both these two stocks.
Okay, Nigel, thanks for that. Well, because of the market mood, you could see some of these vulnerable names, the real estate stocks, NBFCs under pressure today, Lata?
Yeah, I think it was more because the way they rallied yesterday. The realty index was the best performing index. If you took the BSE realty, I think it was up 3.5%. And if you took the NSE realty, it was about 3%. As well, the NBFC stocks, financials did extremely well. And probably this was hope on some SOP. So early morning today, given the mood in the global markets, there could be a bit of give back on these stocks.
Okay, well, here's a quick recap of the top stocks to watch today then. Interglobe Aviation, Wipro, L&T Finance, M&M Finance, India Bulls Real Estate, Nitesh Estates, DLF, Canfin Homes, GIC Housing, Shriram Transport, Bajaj Finance, Hexaware, KPIT Tech, L&T Infotech, Lakshmi Vilas Bank, IDFC Bank, Syngene, Bharti Infratel, Tata Steel and Tata Sponge. Yes.
So all those are, much of them, of course, are results. We'll take a quick break. We are coming back with our technical experts and our F&O expert, Ashwini Gujral, Sudarshan Sukhani, Mitesh Thakkar with us in a minute.
Welcome back. The SGX Nifty is down about 111 points. Now, do remember, yesterday there was a gap up that was sold into, and market went into the red and then had a sharp bounce back. So, it's the opening and closing really have been completely different over the last few days. Ashwini Gujral, Sudarshan Sukhani and Mitesh Thakkar now join us. Good morning. Ashwini, very treacherous day for traders yesterday, the way intraday moves were happening. How do you trade in a market like this? What would be your trading orientation today?
Well, good morning. This has been the nature of the market. If you see over the last 6 days, on 3 days, Bank Nifty gapped up, I think 300-400 points and gave up a lot by the end of the day. I think a couple of times it gapped down and, came back. So, strategy is never a constant. It has to change with the market. This appears to be a fairly whippy market because, markets fall when people are long. Markets go up when everybody is short. This is a low participation market because it's, throwing people all over the place and slowly the participation is reducing. So my sense is that the best trade for the morning is to buy this gap down. If you start breaking 10,100, that's the end of it. But chances are that you will get strong rallies and they will allow you to profit at higher levels. Maybe yesterday's high thereabouts, 10,250, we could not cross. Around those levels, you probably could take the short side. I don't think these moves in the market really mean a whole lot, and this can continue for a while. So the worst thing to do is to try to buy or sell breakouts or breakdowns. So that's the nature of the market. Gap down, you buy, gap up, you sell, and chances are you will make something.
And respect your stop losses in this case very carefully. Well, there is a big risk aversion with dollar index looking so good. So we can't consider ourselves safe havens. So we have to bear the brunt. So Sudarshan Sukhani, good morning. What's the trade today, either for today or for a position?
Yeah, good morning, Lata. Well, the positional trade yesterday was to go long on a dip towards the lows. That happened yesterday itself. So if traders are long, they should simply maintain their long positions. If you are not long, do nothing today. Markets are volatile on two accounts. First, the world markets, and second, the F&O expiry. So it's very difficult to suggest what will happen now in the morning, afternoon, and then as Anuj said at 3 p.m. So there is no need to trade if you don't already have a long position. If you have it, just stick with it. Now the Nifty is trying to test those boundaries of 10,100, and that's a range rather than a number. It could be 10,050, it could be 10,150. So we'll let the Nifty find out what it wants to do today and then plan a fresh trade tomorrow. So primarily we just want to know whether the boundaries are respected or not finally, and that will not be known in the morning. It will be known after the F&O expiry process is complete.
Okay, well, Mitesh Thakkar is also with us. Mitesh, hi, good morning. You get a sense that there could be a big gap down opening and a buying post that, or do you reckon that it could be a trend day for the market, just a one-way slide?
Good morning, Sonia. We've kind of in the last few days on multiple occasions gone below 10,150, and you can pick random points, but around 10,120, broadly give and take a few points, is where we have kind of bounced back from. The negative opening could see the Nifty open around those areas again. The indicator setup as of now I think doesn't look very conducive towards continuation of the fall. So in case for the first 30 minutes we don't see 10,100 being taken out, then there's a good chance that we are back into this 10,120, 10,300 kind of a zone, and therefore buying could be considered. But I would want to wait for first 30 minutes to take that call. In case we start breaking below 10,100, expect another 100 point to happen, and then this could be this could turn out to be a trend day. And given the fact that we have expiry today, I think it will be slightly tricky. But I think in the first 30 minutes will be a better place to know that answer.
We'll find out, of course, in the first 30 or 40 minutes. Let's talk about stocks then, Ashwini. What are the stocks that you're trading today?
Well, because of the gap down, the levels obviously, get disturbed. But I would think that the stocks probably will remain the same. So HDFC is a buy with a stop of 1730, target of 1765. Bajaj Finance is a buy with a stop of 2295, target of 2340. Financial is a buy with a stop of 395, target of 420. Bajaj Auto is a sell with a stop of 2500, target of 2380. And Ambuja Cement is a sell with a stop of 201, target of 188.
Okay, Sudarshan, your buys and sells?
Well, let us see. First, there is a gap down. So the levels, as Ashwini said, are unimportant now. There's something else. Anuj has already told us about the 3 p.m. effect. So whatever you buy or sell can change character in those last 30 minutes or last 45 minutes. So it's not a good day actually to do anything, but you still have some stocks, stocks that may be relatively less affected by the market volatility. One of them is Bata. Bata is now coming down to a support level. It's a buying opportunity. It's not a day trade. It's primarily a positional trade. Similarly, Dabur, it's outperforming. It's building a nice small trading range. I would assume that it will break on the upside from that range. That's a buying idea. And Voltas, which had a handsome day yesterday. Voltas you could buy irrespective of the market because it's fallen enough, it's made a bottom and it's now rallying. So there are good stocks in this market which you could take a positional trade in or a swing trade for 3 or 4 days. I would not recommend taking intraday trades in any of them. We have LIC Housing and Tata Chemicals which are short selling opportunities, but how do you short sell after a gap down? You still have to wait patiently for a rally and then try to look and sell it. Short selling should be done only intraday.
Okay, and with that, thanks Sudarshan. Let's come to Mitesh's picks. Mitesh, you also have Bajaj Auto.
That's right. I think, good breakdown over there. The earlier swing pivots were violated, so there could be continuation on the downside. I would look at targets of around 2400 and suggest a sell with a stop at 2510. Britannia also made a fresh swing pivot breakdown, so sell with a stop at 5440. Look for targets close to about 5200 over there. I also have a sell on DVs where the indicator setup is slightly negative. Keep a tight stop at 1255. Look for targets of 1210. And the solitary buy call is on REC, which had a good price and volume breakout on the intraday charts. The indicator setup is positive. So around 106.5, attempt along with the stop below 105 and look for a 112 kind of a target.
All right, gentlemen, thanks for that. So those are a long list of stocks that you can trade with. But don't go anywhere. After a short break, we'll get some top F&O trades with a birthday boy, Vinod Sharma of HDFC Securities will be with us. Also, some stock talk coming up with Deven Choksi. Do stay tuned in.
Welcome back. It's time for some derivative trades and we have the birthday boy with us, Vinod Sharma of HDFC Securities. Many happy returns of the day, Vinod, and let's hope that good luck comes both through the markets and to you in the year ahead. Well, first up, you won't trade the Nifty today because it's going to be a rocky day. Would you prefer stocks?
No, you can obviously trade the Nifty. So essentially, we have seen and a lot of have been spoken about both all three of your guests. So I think Nifty can be bought at around 10,100 level. Should it come, you can buy that call, and just for this and ensure that you take your 30-40 points and go away. But individual stocks, I think there is some more visibility here. I'm trying to, let's say, face the headwinds in the NBFC space and feel that this is the time when the men will be separated from the boys. So especially people will hanker for good companies where the management has green, the results are out of the way, the management has given a clear, let's say, direction that they'll be possible to grow 35%. So I'm buying the 2,300 call in Bajaj Finance at 20 rupees. Yesterday it closed at 34. So should it dip, I'll buy at 20 rupees. No stop loss for me in this and a target of around 40. M&M Finance came out with stellar results. Also a good play on the rural consumption as well as a good management which can get any kind of money that it needs. So I'm not bothered here. I'm buying the October 400 call at around 6. It closed yesterday at 9.5. My target here is at 11 and stop loss at 3. Then ITC, I have two strategies. One for today, 288 it is closed, and I'm buying the 290 call at 1 rupee. Yesterday it closed at 1.3. So no stop loss in this because you're buying at 1 and hope to gain 2 or 3 rupees here on ITC. In I'm also suggesting to buy a November 290 call in ITC. It closed yesterday at 11. I'm suggesting to buy at 90. We expect that there could be a surprises here in the results here, which come tomorrow. So I'm buying the 290 call at 9, stop loss at 6 there, and a target around 15. And Hindustan Lever is my last pick. And here I'm suggesting to buy the 1580 call at around 7, stop loss at 3, target around 14. And all the stocks, I think the result is, except in ITC where we feel the result will be good, all other cases the results are out of the way.
Okay, Vinod, you have a great day. Hope you make a lot of money whichever way the market goes and your birthday wish comes true. But on that note, we're going to take a short break. We'll come back with the pre-opening rates. Devin Choksi of KR Choksi Securities will also be with us. 5 more minutes to go before the pre-opening rates kick in.